Hi traders, you're welcome back to the Forex Geek channel. Now in this video, we're just going to be diving into one of the most powerful trading concepts that professional traders and institutions use, and that is the accumulation and distribution strategy. Okay, if you've ever felt like you are always entering trades too late or getting caught on the wrong side of the market, then this strategy is going to be a game changer for you. Okay, by the end of this video, you'll learn how to identify accumulation and distribution zones. You're going to learn the key patterns and volume signals to watch for, how to enter and exit trades with confidence, and common trader mistakes and how to avoid them. Okay, so make sure to smash that like button and subscribe to the channel for more pro level trading content. All right, let us get started. Now, to trade effectively, you need to understand how smart money operates. Institutions don't just buy or sell at random. They accumulate and distribute their positions strategically. Now, let's talk about the accumulation phase first, okay? This happens when institutions and big players are quietly buying an asset at low prices. When they are quietly buying an asset at low prices, all right? Quietly buying an asset at low prices, okay? Before a major uptrend. All right, so that usually happens before a major uptrend. Okay, so price action appears sideways. You can see what is happening here. You can see how we are having kind of a sideways movement between here and here, right? We're having a kind of a sideways movement. Although this doesn't exactly seem like, a serious accumulation phase, because we didn't exactly have a very long uptrend after the breakout. Okay, so but let's just use this as an example though. So because initially it's going to be a sideways market where the big players are accumulating their positions, right? And then volume increases suddenly occur as well. You're going to see some small fluctuations and volume increases, okay, as the institutions load up on their positions. All right, let's just see if we can find a better example. Okay, let's see. All right, I think we might be able to use this because you can see that we have I think this might be a good example because we have some small fluctuations within these zones, within this zone, and you can see price is actually consolidating. Price was moving sideways, so this was a possible accumulation phase. And right after that, you can see we had a significant upward move, right? We had a significant upward move, and we even had there was quite a brief pullback and a continuation. Can you see? So this was actually a significant upward trend right after this phase. So this was quite a significant one. So retail traders often miss this phase because it looks like a consolidation with no clear trend. Then for the distribution phase is when traders, or rather when institutions, offload their positions to retail traders before a market downturn. So the market might look like it is breaking out. The market might look like it is breaking out, right? It might look like it is breaking out only to reverse sharply. So then volume starts to spike as smart money exits. Okay, let's just add the volume indicators to see if we had any perhaps significant. And let's just also add the accumulation distribution indicator as well. Okay, so we can see that this seems to be a kind of a phase of distribution, right? And you can see that there was an increase in volume around here, right? There was can you see this volume level was quite higher than the previous, right? So being able to spot these phases early means you can trade in sync with the smart money instead of reacting too late. Okay, now that we know what these phases are, let's talk about how to spot them on your chart. The first thing is to look for sideways movement. Accumulation zones tend to form after a downtrend. All right, after a downtrend, you're going to find the accumulation zones, okay, where price starts moving in a range. Then distribution zones appear after an uptrend, okay, where prices start moving sideways before dropping. All right, so most likely you'll find a sideways move before you now finally have a drop. Then you have to check volume activity as well. In accumulation, volume gradually increases as the big players buy positions, okay, but in distribution, volume spikes, as institutions start to sell to retail traders. Okay, then watch for week off patterns. Accumulation, during accumulation phase, price creates higher lows within a range. All right, you can see what happened here. Price creates higher lows within a range, hinging at a future breakout. Then during distribution pattern, price forms lower highs. All right, so if you find such a scenario, although we didn't exactly have that happen around here, that is for the distribution, right? Okay, but in case you find such example, you might find perhaps a sort of consolidation phase. You might find a sort of consolidation phase just right before the bearish breakout happens. Okay, you might find a sort of consolidation phase before a bearish breakout happens, and you're going to find increase in let's just say there's something interesting here. Then you might also find increase in volume. As well. Okay, anyways, once you've identified these zones, it is time to plan your trades. So let's talk about how to trade these zones effectively. For the accumulation phase, you enter you wait for a breakout first. Then once price breaks above the accumulation range, it signals that smart money is ready to push price higher. So you confirm with volume. If the breakout happens with a volume spike, it is a strong confirmation. Then you enter on a retest. Okay, after the breakout, price often pulls back to accumulation zone. So this is the best time to enter long. You place your stop loss below the accumulation range to protect your trade. Then with respect to the distribution, let's just see if we can find a better example, a good example. Okay, let's see if we can actually find a good example. All right, okay, this looks interesting, right? So remember that, all right, I think this is even a better example for our accumulation. This was a good example for accumulation, but this seems to be an even better example for both accumulation and distribution, because you can see we kind of had an accumulation phase around here, and you can see we had a breakout, we had a retest, and we had the price just zoom up to this point. And then when distribution was about to happen, you can see that we had a consolidation again before the price now started to drop, right? So now with respect to distribution, you wait for a breakdown first. Then if price breaks below the distribution range, it means that smart money is selling. All right, you confirm with volume, okay, because a high volume breakdown confirms the move. Enter on a retest, right? You get a retest after breaking down. Price often comes back to retest distribution zone. It happens somewhere around here though. Although this seems kind of like a retest, but it didn't exactly get to the highest point. But even if you had entered here, you can see that this didn't get above the distribution phase. So the stop loss, setting the stop loss above here would have still been intact, right? So of course, because this is the ideal place to set your stop loss above the distribution range. So even if you had entered after this, seemingly retest, you would still enjoy this ride all the way down, okay? Because this retest will not have hit your stop loss. Okay, you can see it wouldn't have hit your stop loss, but the stop loss would have been above the distribution range. All right, so using these simple entry techniques, you can catch major moves before the market fully reacts. Even experienced traders can make mistakes when using the accumulation and distribution strategy. So here are some key pitfalls to watch out for. The first is jumping in too early. Don't just enter because price is moving sideways. Wait for a confirmed breakout or breakdown, okay? Secondly, do not ignore volume signals. Volume is the key to identifying real accumulation and distribution, okay? If a breakout happens on low volume, it's likely a fake move, okay? And then do not place stop loss too close. Market makers often trigger stop loss orders before a big move. So give your trade some breathing room to avoid unnecessary losses, okay? And do not force trades, all right? Not every sideways move is an accumulation or distribution zone. So just be patient and wait for clear confirmations. By avoiding these common mistakes, you'll increase your accuracy and trade with confidence. And that is it, traders. Now you know how to spot accumulation and distribution zones, trade them effectively, and avoid costly mistakes. If you found this video helpful, hit that like button and subscribe for more powerful trading strategies. Comment below, have you used accumulation and distribution in your trading? What is your biggest challenge with this strategy? Let us discuss. In the meantime, thank you for watching, and I hope to see you in the next video. Happy trading.